Hi everyone, my name is Navin and I'm from Harcourt's Greater Springfield. Today we're meeting Sloan Wilkins from Executive Financial Coaching, where we're going to talk about financial matters, especially once you've sold your house. So let's welcome Sloan. Hey Sloan.
Good to be with you. Thanks for having me.
Thank you, Sloan. Firstly, thank you for your time today, and can you please tell us a bit more about your background and what Executive Financial Coaching is about?
Yeah, absolutely. So I've spent 30 years in financial services, and now actually 32. So I spent 30 years in the corporate world, all manners of banking and financial planning roles.
Yeah.
And 2 years ago, I jumped out of the corporate world into my own business, and I'm now helping with people in the area of financial coaching, which a big part of that is making sure that we focus on the small stuff, looking after our income, being in control, and the big stuff, where are we going and what's most important to our families.
Okay, so what prompted you to make that change from coming from the commercial side of things into your own business?
Yeah, 30 years was a big milestone, so hitting that threshold there made me reevaluate. And also in the last couple of years, actually leading up to the pandemic in 2019, the organisation I was working with, we were doing a lot of thinking and trying to pull together a program of how we might help the members that we were serving to do better with their financial stress, because that was already starting to rise, and we knew that interest rates were low but going to bounce back. So we expected financial stress to get a little more challenging for people.
Yeah.
So thinking more and more and delving into the world of financial well-being, it just really resonated with me.
Yeah, that's great. So let's dive into, I guess, the property side of things. What are some financial scenarios from your experience that you see families are faced with when they're selling their property?
Yeah, so oftentimes we're selling for a range of different reasons. Sometimes it can be reasons that are born of opportunity, where we're transferring into a new role or coming into an area for the kids to get into the best school that they want. Other times it can be financial challenge that means that we're selling. So there's those two ends of the spectrum and everything in between. So families are often thinking about, I guess like we all do, how can we make the most effective decisions with what we're doing with our property and position ourselves for what comes next, which is going to be different. So throughout all of those decisions, it pays to do a couple of things. One is have a really good real estate agent in your corner, so you can talk with them and trust them and have a good relationship and get the right advice. The other is being really clear on where to from here. Like we know where we are now, but what are the decisions that we're trying to make about moving forward? And if we're clear on where we're going, sometimes that presents us with a few different options that we might like to consider with regards to our property decisions.
Okay. Can you dive a bit deeper into when you said having different options, and what are some options and how do they actually impact our decisions?
Yeah, look, some of those options could be the classic, are we looking to replace the type of property that we currently have now, or is our lifestyle changing? So it can be that we're either looking for more space because now we're starting to have some animals that we need to take care of, or we're riding trail bikes and we'd like a big expansive area to be able to ride those around. Or maybe we're at a different stage of life where downsizing becomes more relevant. Time is busy, we're focused on the career, and we can't look after the same size yard that we used to have. So that's a couple of examples on the property side there. I guess on the financial side, what we're seeing now in recent times with interest rates rising so rapidly, affordability is a big factor for people. So what may have been affordable before may not be moving forward. So we're seeing a bit of a movement where clients are thinking about, do we retain the investment property that we've got if it's not cash flow positively geared, and whether they can in fact retain that, because naturally our own home and that castle that we've got there, we want to defend that first and then think about the investment opportunities. So if there's any unwinding to do, it typically happens in reverse. We will let the investment property maybe go on to another owner, bank that cash and protect our own circumstances at home, and that gives us the capacity to move forward from there.
Talking a bit more about investment properties and interest rate rises at the moment, how does one, let's say there's a family with a residential home and say 2 or 3 investment properties, how then do they best navigate these trying times, I guess?
Yeah, I guess right now, at the time that we're talking, you want to make sure that all of your interest rates, as much as possible, begin with a 5.
Yeah.
If it's got a 6 in front of it, you're probably paying too much.
That's me.
So it's an opportunity.
Yeah.
Naturally, there might be some fixed rates in there as well, which are locked in at a lower level. So enjoy those while you can,
Yeah.
and you do need to plan ahead for those. But right now, it's really important to know a couple of things. One, your bank wants to hold on to good customers, and it is far easier and cheaper for them to retain you as a customer than it is to win a new customer to replace you if you go somewhere else to get a better deal.
Yeah, okay.
So I would really recommend either talking to your bank directly or engaging a good mortgage broker to do it on your behalf to try and get the best deal you possibly can. Oftentimes we think that we need to move our loan in order to get a better deal, but that's not always the case. And moving seems like a really big task. Yeah. So often we sort of maybe sit on it longer than we should have, and the banks, I won't say that they take advantage of that loyalty, but they're not as really proactive in reaching out and sort of suggesting, hey, we've got a better deal for you. Yeah. You need to be on the front foot having those conversations with them.
Yeah. I can't imagine any bank would be like, hey, we've got a better deal. Okay, so let's talk about when sellers sell their property and they're left with a tidy profit. And I guess that's where you come in a fair bit as well, because you're left with a fair bit of cash flow. What are some common pitfalls that someone in that situation might have to navigate?
Yeah, that's a really good question, and it does come up a lot, and there's several different things to think about when that happens. The most immediate question is what's coming next. Yeah. So if it's our own principal place of residence that we've sold, have we already contracted to buy our next one, and what do the financials look like around that? Or is it an investment property, and now there is a decision to be made about where that cash can be diverted to? Yeah. So it sort of depends on which way the client is heading as to what the circumstances are and what they should do with that. Yep. But when things are uncertain, a really good approach is to stockpile cash. So if we are uncertain about what's going on around us, or whether we'll qualify for the size of the loan maybe for our next property move, it makes sense to park that cash somewhere we can readily get our hands on it. So if we're ready to make that next step, we can do it. But naturally, we don't want to let cash sit there for a long period of time if there isn't a plan for it. So the other pitfall that I think sometimes we fall into is all of a sudden we've realised this opportunity. There's this tidy sum that's there, and it can be tempting to dip into that for some projects or items, even new vehicles, etc., that we've maybe had our eye on but haven't taken action on in the past, and all of a sudden this lump sum is here. So it's really tempting to make some of those decisions which may not be lined up with our longer term goals. So it's not necessarily a matter of no, it's does it make sense right now? So stopping, pressing pause, being clear on where you're going.
Okay, so that's quite interesting to know, Sloan. Do you have any examples of such situations that with clients you're working with at the moment?
Yeah, I do actually. I've got a client interstate, and they've recently relocated from one capital city to another, and that involves them selling the property because it's a permanent move. They're not going back to where they've come from. As a result, they're in the new capital city and they're currently renting. So right now they've got a large amount that we had a discussion, found out that was sitting in just their savings account, and they do have some other investment properties with loans. Sorry, not investment properties. They do have other loan facilities with offset accounts, which currently have $0 sitting in them. So simply through the course of the conversation and switching some funds from where it is sitting in their cash account across into the offset account, that was a $22,000 saving for them on an annual basis, just by moving accounts from one to the other. So it really does. It matters that we pay close attention to what we're doing with the funds and where they're sitting.
Yeah. Do you find that often people aren't aware of what an offset account actually does?
Yeah, it's a term that gets thrown around, and I need to catch myself always because I've grown up in and around the finance industry, so we're sometimes good at using terminology without stopping to explain that. So the easiest way to understand what an offset account is when we have a home loan, it is possible certain of them have an offset account. If the home loan, let's say, for example, is 500,000, and we have 100,000 sitting in the offset account, then it means that interest is only calculated on the difference on 400,000 in that particular scenario. Yep. The 100,000 that's sitting in the offset account still remains accessible to us. We can access it on a daily basis if we need to, but it's generally best to park only money there that we're not needing right this week.
Okay. Can you explain how an offset account makes sense for the bank? I guess what is in it for the bank to have your money in an offset account and not charge you interest on your bank loan?
Yeah, it probably makes sense on a few different levels, and you're right, it is counterintuitive when you think about it. Yeah. From the bank's perspective, what they want is a longevity of relationship with their mortgage holders, and with competitive rates. If it was only rate that it came down to, and you would probably see people jumping and changing between mortgage providers quite regularly. If the bank can help the client do well and feel like that they've got a good deal, the interest rate's okay, plus I know I'm saving through having money sitting in my offset account, overall I feel pretty comfortable. So I'm less inclined to be shopping around for a better deal, and more likely to stay with the bank over time.
Can you share a bit more about good debt and bad debt?
Yeah, absolutely. It's some labels that we apply to things, and some of those labels sometimes make us feel comfortable about debt that we shouldn't have or that we've got too much of. So bad debt, really obvious things like credit card and even buy now, pay later, I would put very much into that category. Some people like to think it's not debt because it's over in 4 payments. Yeah. But if you don't make those payments, it very much is something that you'll be paying late fees on and they'll be chasing you for. Yeah. So that's sort of bad debt. I in fact like to use the term sort of productive and non-productive debt. So there's things that we're spending on lifestyle which might be really enjoyable, but that's probably non-productive if we've got a personal loan for a holiday as an example. Great experience, we've enjoyed it, but the debt came home along with the memories. So we don't like to see that lingering there. So debt that is more useful or productive is being in our own principal place of residence, possibly looking at investment opportunities, whether that's into an investment property or some other type of vehicle, or productive for business purposes and growing and expanding. So those sort of debts, they're useful in that they help us to move forward towards our goals. The non-productive debt either stop us in our tracks or hold us back from being able to access opportunities and live our best life.
Is there a situation where a residential home loan becomes bad debt?
From the perspective of it being too large and too unwieldy, yes. I think we've seen lots of stories in the media over the last 12 months or so where people have borrowed up to the maximum that their bank has been willing to extend to them, and now with some interest rate rises they're finding out we went too far, and we maybe should have dialed back. And I balance that with other stories where people have been approved for 900,000 but they've chosen to purchase the property for 600,000, and they're feeling a sense of relief that they made the right decision. So even though the purpose is productive and we all like to feel safe and have a roof over our head, if we've got too much house, then it can help to bring us undone. And that's probably one of 3 areas where people do get stuck and run into problems with their finances. It's typically too much house, too much car, or too much lifestyle, or a combination of those, and that can make life pretty tough and financial stress starts to grow.
On that note, is there a situation where if you have the funds to pay off a debt, you suggest not doing so?
It's always good to look at the situation surrounding the math, because the math might indicate that it's a good decision to do. But then we need to look at it in the light of the circumstances for that individual or that family there as well. Just because it makes sense in a spreadsheet doesn't mean that we should do it. So we live our life outside the spreadsheet. So it's best to have a look at both those equations. An example of that would be, and I was looking at this recently, where we have some credit card debt as an example, outstanding for a client, yet we have enough sitting in a cash account, or maybe even an offset account, to be able to clear those credit cards in full, and then run the scissors through them and cancel them so that they're out of our life forever. So that was, it made sense for that client I was looking at, because the differential there, it was saving them around about 5.5% by sitting in the offset account against their mortgage. However, their credit cards are being charged at roughly 19.99%. So it's almost 4 times the amount of interest that it will be saving them if they can get rid of those. So that makes sense. In other circumstances, if those funds were needed for another project that was upcoming or a property purchase that was about to happen, then maybe it doesn't make sense to do that.
Yeah, so it's, I guess when you're advising someone, it's kind of like the art and the science. The science of it is the figures, and the art is kind of like what reality is for that family, I guess. Yeah,
100%. There's, I guess there's head decisions and then there's heart decisions there as well. So what feels right, or what's going to help our family achieve their longer term goals, could be different from what the right answer is mathematically in this moment.
Yeah, perfect. Let's talk a bit more about superannuation. So what are the pros and cons of parking our funds in super, and what are some misconceptions?
Yeah, look, super's a really great environment to invest in. And one of the misconceptions or phrases that I sometimes have heard over the years is, I don't believe in super, or my super lost money, etc. So it's important to really separate that superannuation itself is the environment or the vehicle, and inside that you can have many different styles of investments, all the way from cash to property and shares, etc. there. So it's actually the investments that you choose that move up and down in value. Superannuation as an environment provides some really good tax benefits, and that's why it makes sense often to have longer term funds in there. So typically superannuation is not somewhere we would park short term money. Any money that's going in there, we need to be comfortable that it will be staying there until we reach preservation age, which for anyone born after 1964 is 60 years old and retired. So it can be quite long term. So you do get the good tax benefits, but it is saving for your future.
Okay, so what about deductible and non-deductible debt, and how it affects the repayment of a home loan?
Yeah, really good question, and it's something that we often need to think about, particularly if we've come across a lump sum from selling another property as an example, or from some other means. So deductible debt is typically associated with the purpose, such as an investment property, where we're generating income. So the government allows us the deduction on the interest on that facility because we're using it to generate taxable income that they can take a bite out of with their taxes. So it's a bit of a balancing act from them. Non-deductible debt is things like some of the non-productive debt, such as our credit cards and buy now pay later and personal loan, etc. And also our own home loan, the interest on that is non-deductible as well. Typically from a tax perspective, and check this out with your accountant, but if I had $100,000 and I had the choice between paying that off my home loan, which was the same size as an investment property loan I had, most often you would opt to pay that off the non-deductible debt.
Yeah, because with the investment property you get to deduct it.
Exactly, and you maintain a higher level of interest deductions for that property there, which helps the overall investment profile of it. Whereas your own home, there aren't any benefits to be had there, and you'll save some interest. That's the benefit that you receive. Okay,
so now that you've mentioned deductible debt, with the current climate where interest rates are rising, where it seems to no end, what are your thoughts around investing in an investment property?
Yeah, look, it still can make sense. You need to be very careful and do your sums, both with yourself and perhaps with your accountant if you're working with one there alongside your mortgage broker. So it can make sense for the right people. Obviously, there are lots of individuals and families out there that are looking to rent quality properties, and we know that rent has been increasing significantly out there. So that balances up potentially with the rising interest rates, but you need to do your numbers on those. I wouldn't rule it out simply because interest rates are higher than they have been. historically, interest rates are probably approaching where you might expect them to be on a longer term basis. So we've been blessed with having really low interest rates for a few years, and we've become comfortable with that. But now we're approaching a renewed normal, and we still need to think about the next 20, 30 years, how we're growing our wealth, and interest rates will ebb and flow throughout that entire period. So does it make sense for us now? Does the property look good? Talk with your real estate specialist so that you can make sure that you're investing into an area with a good growth profile, and that way you'll be well positioned for the future, provided that you don't borrow too much right now.
Okay, Sloan, we're almost at the end of the discussion. The last question I guess I have is, once we have sold a property and we've had that big windfall as such, what would your advice be to a family, let's say, who's planning to use that money to fund interior decoration or purchase big ticket purchases like furniture and things like that? How should they apportion that money?
Yeah, look, I would be looking at, there's a difference between soft furnishings and any renovations that you might want to do to the house there. Obviously, soft furnishings make our existence really nice, and we're in a comfortable environment there. So 10,000 spent on furniture will make us feel very good. If it's 10,000 on a quick bathroom reno, to the extent that you can get that work done for that price, that's going to add value to the property there as well. So again, it's not an either or. It's potentially thinking about the timing of when we do these things and putting some parameters around it. So particularly with our soft furnishings and the new appliances, etc. there, how much do we want to spend? So there isn't a magic percentage to go with there. It would be really easy if it was, but we need to look at our circumstances and say, given what we've got coming up, how much can we reasonably afford to spend on these items? And if we really love luxury items, then it becomes a matter of staging that. So, this 3 months we're going to purchase this particular item. Our next goal is going to be the next item on the list there. And so coming at it from a perspective of not overspending, and as much as possible trying to cash flow and save for those items rather than just putting it on the plastic.
Yeah, so just to clarify, because if a family has the funds sitting and let's say they're moving in, you're suggesting that they should still try and cash flow the soft furnishing purchases, just so they're not entirely like going all in and dipping into their profit from the previous sales, are we saying?
It depends on the circumstances. If there's the funds that's already there, then and you've allocated them specifically for that purpose, then go for it. You've made some solid financial decisions, you've got the funds there, you deserve to enjoy them. It is your money after all. And I would just sort of say, hey, look, stop, gain a little bit of clarity, pull the lens back and sort of saying, whilst we've got the money and we're spending it on those items, it's been allocated for that, big tick for that. Are we still okay? Do we still have a fully funded emergency fund of 3 to 6 months worth of expenses, or will those purchases eat into those funds there? And are we still okay?
Thank you for that. And I'm just going to share, I guess, a bit of my experience as well, because we recently moved into a new home, and one of the big things that I had planned for sure was a fish tank. I'm quite into my fish tanks, and I had done the math, and it was going to cost like $7,000 to $8,000 at least, and I had budgeted for it. And once we moved in, but we're doing landscaping now, and things just pop up as well, like when you're doing with the recent rains and all that. So it's got me distracted from the fish tank for a bit, and then now that I look back and think, you know what, like actually I don't really want to do it, because I think that money can be, like you said, instead of going in or like take a step back. And taking a step back has allowed me to, I guess, gain a bit more clarity into, do I really want to spend $7,000 to $8,000 on a fish tank? And
sometimes it's we do need to say no to ourselves, and other times it's more of a case of it not yet. And particularly when we're moving into a new house, there is so much to spend on. And tradies are great to work with, but it's not unusual because sometimes they don't know the extent of the job until they start the job. So what we think might be 10 grand worth of landscaping can turn into 15 as just an example there, because there's something extra that makes sense to do. So whilst we've done our budgeting, we've allocated the money, often it's good to let one thing play out and then we're ready for the next thing, because once it's done, we know the full extent of our expenditure. Does that change anything, or are we on track?
Yeah, perfect. That's amazing advice. That's good. Well, thank you so much for your time again, Sloan. I think this was a really good discussion. Thank you so much for making time for us today.
Pleasure. Always good to have a chat about money.
All good. Have a good one.
Thanks, mate.